Hello, my name is Ian Alden. I'm a tax attorney here with Law for Small Business, and I'm here today to talk to you about the recent tax reform law called the Tax Cuts and Jobs Act of 2017 by Congress, and what it might be able to do for your new or existing business. Before I get into tax reform, it's important to cover some of the basics of how businesses are taxed in the first place. And so, as a preamble to that, I want to stress that this video and the tax reform law in general primarily deals with income taxes faced by businesses and business owners. This doesn't really cover sales tax, gross receipts tax, or any of the other types of taxes, self-employment taxes. We do have other videos and articles about those taxes, and I'd encourage you to have a look. Now, there are two types of business entities as far as taxes go. You have either your pass-through entities like sole proprietorships, partnerships, subchapter S corporations, and you have your double tax entities like subchapter C corporations. You pass-through entities, all the profits and losses automatically flow through from the business to its owners. So the business might file an information return at the end of the year, but it doesn't pay any taxes on its income. All of those taxes go right to the owners, which are then paid at the owner's own personal marginal tax rates. By comparison, a double tax entity like a C corporation is its own taxable entity. It receives the profits and losses from its business, it pays the taxes on it, and then it holds that money either for reinvestment or to pay to its owners in the form of a dividend. When a C-corp pays a dividend to its owners, the owners then pay taxes a second time on those dividends at the owner's own rates. That's why it's called double taxation. Now, before tax reform, the top marginal rate for a C corporation was about 35%, and the top marginal rate for individuals or owners was about 39.5–40%. So if you add those two together, if you're paying 35% on income and then 40% on what's left, obviously that's a huge tax hit, and that's why C corporations were out of favor for so many years. Small businesses tended to lean towards pass-through entities, and larger businesses may have stuck with C corporations because their owners may have had tax rates higher than 35%. Maybe they wanted to reinvest the income and take the deductions that were unique to corporations, but typically pass-through entities were favored. Tax reform changed the tax rates. That was its big impact. The tax rate for C corporation dropped from 35% down to 21%. Obviously, that's a pretty huge drop. It brought C corporations in line with the tax rates for corporations around the world. We're a lot more competitive now in that area, and so you're seeing more use of C corporations by, for example, larger companies, multinational companies, and it's having some impact in that area. In order to sort of spread the wealth to pass-through entities, Congress created what's called a qualified business income deduction. If your business meets certain criteria, you're in certain favored professions, and all else is met, you might be able to deduct up to 20% of the business income of your pass-through entity from your taxes. Basically, you get to deduct the lesser of 20% of your eligible business income or your taxable ordinary income if you meet the criteria. That can be a huge savings for the owners of pass-through entities. Unfortunately, there are some limitations, as I just mentioned. For example, Congress set limits on what kind of professions are eligible. If you're a lawyer or a doctor, for example, you're not eligible for the QBI deduction. And so one effect that had, aside from picking winners and losers, is that it made calculating the QBI deduction, or even seeing if you're eligible for it, pretty complicated for your average small business owner. And so looking at tax reform at the big picture, I would say it definitely lowered taxes for a lot of business owners, but it didn't really shift the calculus all that much as to which type of business entity you should pick. If you're looking at a C corporation, or if you're looking at a partnership, pass-through entity of any kind, including an LLC that's taxed as one, because an LLC can choose to be taxed as just about anything. What you really need to do is look at the type of business income you have, the type of profession you're involved in, and see, comparing the different entities, what is going to save you the most on your taxes. And that's where we come in. Either a good tax attorney or maybe a good accountant or CPA can sit down with you, look at your business income, and really judge what type of entity is going to be best for you in the short term and the long term. And so if you are looking to start a new business entity, or if you're looking at your current business and saying, maybe I can save some money on my taxes, I definitely encourage you to reach out to us. Don't leave money on the table. Give us a call or visit our website. We'd be more than happy to sit down with you either in person or over the phone, go over your unique situation and see what you might be able to save. Thank you.